Everyone talks about $100,000 like it's just a milestone, just a round number, just a checkpoint on the way to something bigger. But here's the truth most people don't understand. Wealth does not grow in a straight line, and something very real shifts when you cross six figures. Not because the market suddenly rewards you, not because you unlock some secret investment strategy, but because the rules that were always working quietly in the background finally become visible. And if you don't understand what changes at 100,000, you'll either underestimate how powerful that phase can be, or you'll give up long before you ever experience it. Most people think wealth accelerates because of some magical investment trick, or because the market suddenly becomes generous. But that's not what happens at $100,000. The shift is quieter than that. It's psychological before it's mathematical. And if you don't understand what actually changes at that number, you'll either chase it blindly or you'll hit it and completely miss the opportunity it creates. I remember when I first started investing, the numbers felt pointless. A few $1,000s invested felt like nothing. The market would move 1% and I'd make $20. $20. It felt almost insulting compared to the effort I was putting in. And that's where most people live for years. They're doing the right things, but the feedback loop is so small that it doesn't feel meaningful. That's why the first stretch is brutally hard, not because it's mathematically complex, but because it's emotionally unrewarding. When you're below 100,000, your income matters more than your investments. Your savings rate matters more than your returns. Your behavior matters more than your strategy. Every gain comes from discipline. Every step forward feels manual. You skip dinners, you delay upgrades, you automate transfers, you say no more than you say yes. And even when you do everything right, your portfolio barely moves. It feels slow, it feels heavy, it feels like pushing a car uphill with the handbrake slightly on. But then something subtle starts to happen as you approach that six-figure mark. The numbers start to feel different. A 5% year is no longer a couple $100s, it's 5,000. A strong year isn't a psychological pat on the back, it's meaningful money. And that's when compounding stops being theoretical and starts being visible. At $100,000, average market returns begin to resemble part-time income. And that changes how your brain interprets effort. When your portfolio can grow by $10,000 in a solid year without you working extra hours, something clicks. You start to feel supported instead of solely responsible. And that emotional shift is where acceleration really begins. Because once you feel supported by your capital, your decision-making changes. You stop acting from scarcity and start acting from leverage. Before 100,000, you are building momentum. After 100,000, you are protecting and directing momentum. That's a completely different game. Think about it like pushing a flywheel. In the beginning, it's almost immovable. Every push feels pointless. There's resistance. There's friction. You question whether it's even turning. But eventually, after enough consistent effort, it starts to rotate on its own. Slowly at first, then steadily, then powerfully. 100,000 is often where the flywheel begins spinning without constant force. It doesn't mean you stop contributing. It means your contributions are amplified, and that amplification changes behavior. Most people underestimate how powerful behavior becomes once confidence enters the system. When you're undercapitalized, volatility feels threatening. A market drop feels like punishment. You check your account too often. You second-guess your strategy. You interpret red days as personal failure. But when your base is larger, fluctuations feel smaller relative to the whole. A 10% correction on $20,000 feels like disaster. A 10% correction on $150,000 feels uncomfortable but manageable. The numbers are bigger, but so is your perspective. And perspective reduces panic. Reduced panic increases consistency. Increased consistency strengthens compounding. This is why acceleration is not just math, it's emotional stability. At 100,000, you've proven something to yourself. You've proven that you can delay gratification. You've proven that you can survive unexpected bills. You've proven that you can invest through uncertainty. That identity shift is enormous. You stop seeing yourself as someone trying to build wealth and start seeing yourself as someone who builds wealth. That subtle identity change influences every financial decision that follows. You negotiate differently. You spend differently. You think in decades instead of months. You stop chasing hot trends because you don't need a breakthrough anymore. You already built one. And here's something else that no one talks about. At lower balances, your financial growth feels entirely dependent on effort. At higher balances, growth feels partially inevitable. And inevitability creates calm. When you feel calm, you make better decisions. When you make better decisions, you avoid costly mistakes. Avoiding large mistakes is often more powerful than making brilliant moves. One bad decision under 50,000 can wipe out months of progress. One bad decision over 100,000 still hurts, but it rarely resets you to zero. That resilience is fuel. There's also a practical reason acceleration becomes noticeable. Contribution fatigue declines. Early on, you are the engine. You save aggressively, you optimize everything, you question every subscription, you hustle. But as your portfolio grows, the percentage of total growth coming from market returns increases relative to your contributions. In the beginning, 90% of your growth is from savings. Later, a meaningful portion is from returns, and when returns begin to rival your annual contributions, it feels like you've hired a silent partner. That silent partner works 24 hours a day. It doesn't take holidays. It doesn't argue. It compounds. And once you have that partner, your strategy evolves from accumulation to allocation. You start asking better questions. Instead of how much can I save this month, you start asking how do I structure this capital intelligently. You think about tax efficiency. You think about risk management. You think about optionality. Optionality is underrated. Before 100,000, you don't feel like you have options. You feel like you have obligations. After 100,000, you begin to sense optionality emerging. You could switch roles. You could reduce hours. You could take a calculated risk. You don't necessarily act on it immediately, but knowing you could changes how trapped you feel. And freedom, even partial freedom, improves decision quality. There's another dimension to why wealth accelerates after $100,000. And it's less about the visible portfolio number and more about the invisible systems that begin to lock into place around that level. When you're earlier in the journey, your financial life is fragile. One unexpected expense can undo months of progress. One emotional decision can erase a year of disciplined investing. You're still experimenting. You're still figuring out how aggressive you really are, how patient you really are, how you actually respond when markets fall 10 or 20%. But by the time you've built six figures, you've usually experienced at least one real test. You've seen volatility. You've felt doubt. You've had moments where selling felt rational. And if you're still standing at 100,000, it means you didn't just save well, you endured well. That endurance is an asset most people don't account for, but it dramatically reduces future self-sabotage. Wealth accelerates because fewer resets occur. Most people don't fail from lack of intelligence. They fail from interruption. They interrupt compounding by chasing trends, by panicking, by upgrading their lifestyle too quickly, by letting ego dictate decisions. At lower balances, these mistakes are more common because the emotional pressure is higher. When your portfolio is small, every percentage point feels amplified. When it's larger, you operate from a wider emotional bandwidth. You can zoom out. That zoomed-out perspective changes your time horizon. Instead of thinking in quarters or years, you begin thinking in decades. And when your time horizon expands, your risk tolerance becomes more rational. You stop needing quick wins. You start valuing durability. Durability compounds more reliably than excitement. There's also a structural shift that happens once you cross into six figures. Your money starts working in multiple directions simultaneously. Dividends, interest, capital appreciation, maybe even small business income streams begin layering. Even if each stream is modest, together they create reinforcement. Reinforcement builds momentum, momentum reduces doubt, and reduced doubt increases consistency. It becomes easier to automate contributions because you trust the process more deeply. Automation at scale is powerful because it removes decision fatigue. Decision fatigue is expensive. Every time you have to decide whether to invest, whether to spend, whether to adjust, you risk deviating from your plan. But once you've built meaningful capital, you tend to simplify rather than complicate. You default to systems. Systems compound better than motivation. Another overlooked reason wealth accelerates is because opportunity cost becomes clearer. At lower balances, spending decisions feel isolated. Buying a new device or taking a spontaneous trip doesn't feel like it meaningfully alters your long-term trajectory. But once you see six figures sitting in your account, you understand leverage differently. You recognize that every dollar deployed wisely has exponential potential. That awareness subtly raises your spending standards. You don't stop enjoying life, but you become more selective. Selectivity preserves capital. Preserved capital compounds. And as compounding becomes more visible, it reinforces restraint. It's a positive feedback loop. The irony is that wealth acceleration often feels slower emotionally, even as it speeds up mathematically. In the early phase, every $1,000 milestone feels exciting. 10,000 feels huge. 20,000 feels like a breakthrough. But at 100,000, the increments grow larger and paradoxically less dramatic. You become less reactive to milestones and more focused on trajectory. That shift toward trajectory thinking is sophisticated. Instead of celebrating numbers, you evaluate direction. Is my net worth trending upward consistently? Are my systems aligned? Is my earning power increasing alongside my investments? That holistic awareness reduces volatility in your behavior. Behavioral volatility is one of the most destructive forces in personal finance. Markets fluctuate. Economies fluctuate. But if your behavior remains stable, your outcomes improve dramatically. Six figures often marks the point where behavior stabilizes, because you've already proven to yourself that the strategy works. Confidence derived from lived experience is more powerful than confidence derived from reading books. You've felt compounding firsthand. You've seen money generate money. That lived evidence eliminates much of the doubt that plagues beginners. Doubt is expensive because it causes hesitation at critical moments. It causes people to pause contributions during downturns or pull back when they should lean in. Once you've crossed 100,000, downturns begin to look different. Instead of threats, they look like temporary distortions. You've accumulated enough capital to recognize that volatility is the price of admission, not a signal to exit. This reframing allows you to continue investing during uncertainty, which historically has been one of the most powerful wealth-building behaviors available. Another acceleration factor is social calibration. When you're early in your journey, you might feel isolated in your discipline. Saving aggressively can feel abnormal. Investing consistently can feel lonely when peers prioritize consumption. But once you've built meaningful capital, you often start attracting or seeking environments where long-term thinking is normalized. Conversations change. You talk less about purchases and more about assets. You discuss strategy, tax optimization, business ideas. Surrounding yourself with people who view capital as a tool rather than a trophy reinforces productive behaviors. Environment shapes decisions more than willpower does. And improved environment compounds just like money does. There's also an internal shift regarding identity and standards. When you view yourself as someone capable of building six figures, your tolerance for mediocrity in other areas declines. You start auditing your career more critically. Are you underpaid relative to your value? Are you in a role that scales? Are you trading time inefficiently? That self-audit often results in income growth. Income growth layered on top of compounding investments creates dual engines. Two engines accelerate faster than one. And once both engines are running, acceleration feels almost inevitable unless deliberately sabotaged. It's important to understand that 100,000 is not magical because of the number itself. It's magical because of what it represents in behavior, resilience, and proof of concept. Proof of concept eliminates excuses. You can no longer say building wealth is impossible because you've already done something difficult. That evidence alters your risk perception. You become more comfortable making calculated investments in yourself, whether that's education, business ventures, or strategic career moves. Calculated risk taken from a position of stability is different from reckless risk taken from desperation. Stability allows for patience if outcomes take time. Patience protects capital. Protecting capital ensures it remains available for the next opportunity. Availability of capital is a competitive advantage. Many people miss opportunities not because they lack intelligence, but because they lack liquidity. When you have six figures, you can deploy capital when asymmetric opportunities appear. That optionality can accelerate wealth significantly over long time horizons. Another psychological factor is reduced comparison. Early in the journey, it's easy to compare your small portfolio to others who seem far ahead. Comparison creates pressure and often pushes people toward unnecessary risk. But once you've built meaningful capital, your focus tends to shift inward. You compare yourself to your previous self rather than to strangers. That internal benchmarking fosters sustainable growth. Sustainable growth compounds more predictably than erratic leaps. And as predictability increases, stress decreases. Lower stress improves decision quality across the board. Financial acceleration is deeply connected to mental clarity. A clear mind makes fewer impulsive choices. Fewer impulsive choices preserve compounding. Over time, a preserved compounding produces extraordinary outcomes. Finally, crossing 100,000 recalibrates your relationship with time. You realize that the early years of effort were not wasted even if the visible gains were modest. They were laying infrastructure. Infrastructure is invisible until load is applied. Once sufficient capital is present, the infrastructure reveals its value. Systems you built when balances were small now manage larger sums effortlessly. The discipline that felt excessive early on now feels ordinary. That normalization of discipline is powerful. When disciplined behavior feels normal rather than forced, it becomes permanent. Permanence is the true source of acceleration. Wealth does not accelerate because the world suddenly becomes generous. It accelerates because friction decreases, behavior stabilizes, systems mature, income often rises, and capital reaches a mass where percentage returns translate into meaningful absolute growth. The acceleration is the cumulative result of dozens of small shifts that converge around this level. Understanding that convergence allows you to be patient in the early stages and strategic in the later ones. And when patience and strategy coexist, wealth doesn't just grow, it compounds with intention. And there is one final layer that makes this shift so powerful, and it has nothing to do with spreadsheets or percentages. It has to do with belief. When you look at a six-figure portfolio and know that you built it, brick by brick, month by month, decision by decision, you begin to trust yourself differently. You trust your restraint. You trust your judgment. You trust your ability to endure boredom and uncertainty. That self-trust becomes a quiet advantage in every financial decision that follows. You no longer need external validation to stay the course. You no longer panic when headlines scream. You understand that wealth is less about intensity and more about continuity. And continuity is easier to maintain once you have proof that it works. The early stage requires faith without evidence. The later stage is fueled by evidence reinforcing faith. That loop is incredibly powerful. It makes you steadier during downturns and more measured during bull markets. It keeps you from overextending when things are euphoric and from retreating when things are fearful. That emotional symmetry is rare, and it is often forged in the climb toward 100,000. So when we say wealth accelerates after 6 figures, what we really mean is that the person holding the capital has evolved. The saver has become an investor. The anxious beginner has become a patient allocator. The person chasing milestones has become someone building systems. And systems once built do not need constant excitement to function. They simply run. They compound. They scale quietly in the background while you live your life. That is the real shift. It is not just that the numbers get bigger. It is that the noise gets smaller. The urgency softens. The identity strengthens. And when identity, discipline, and capital align, acceleration is not dramatic. It is natural.